Yes, hello and welcome to the Business of Property podcast. I'm Stuart.
I'm Simon.
And I'm Simon.
And we've been finding, buying and growing income from property for over 20 years. And we talk every week about the reality of running our property businesses. And as we've been mentioning in the last few weeks, we'd really appreciate it if you could leave us a rating or review. And if you do, you will get a shout out like Raisin Fudge. He left a podcast review saying the podcast show is hugely informative and really hits the mark in discussion topics, which, as a relatively new buy-to-let investor with aspirations for branching out, provide really useful insights, especially the worked example episodes. He also talks about Patma software, which is very, very good. And I just want to say thank you, Raisin Fudge, for that wonderful review. And for everyone else, if you want to join Raisin Fudge and get a shout out on the show, just leave a review and a rating in your podcast player of choice. Now, you will have heard that there are two Simons with us today. So the second Simon is, of course, Simon Glastonbury, our resident mortgage broker with over 20 years of experience, who will join us today. And we're going to do something slightly different today, which is we're going to do a bit of a deeper dive into limited company mortgages, because we know that more people are buying in limited companies. And there's reasons for that, primarily because you get full tax relief. But if you're wondering why we are focusing on limited companies, I'm just going to refer you to some previous episodes. You've got episodes 189, 167, 140 and 135, and that they talk about how we pay ourselves through limited companies. They talk about limited company versus Section 24, which is mortgage interest rate relief or not. Buying property in a limited company. And also episode 135 was about whether or not you should buy in a limited company. So there's a lot of context out there for you should you wish to go back and listen to that. So Simon G, why don't we start with, I guess the first thing people think about is what changes when I buy in a limited company? Because from my perspective, and again, this is just how I think, but I think, okay, well, when I was buying in my own name or with my partner, the first thing I think of is what's the multiple that I can get as with my salary. How do we start thinking about that as a limited company? Because the limited company is now our new entity, is us.
Hi, chaps. Yeah, absolutely. This is a great topic and something which I'll go over sort of the basics of it. So we may be teaching people things they already know, but also there's an overlap here with limited company buy-to-lets and personal buy-to-lets. One thing I would say straight away, accountants have certainly over the last few years cottoned on to this, and in the buy-to-let market, but there's so many accidental landlords which have been going in the market for the last sort of 10, 20 years. And pushing probably be the right wording there to move people over from a personal name over into a limited company name because of the tax breaks. So certainly somebody is looking to do it, is looking to buy their next buy-to-let or increase their portfolio. Certainly one thing I would do straight away, speak to your accountant, because it's definitely beneficial to do it. With regard to criteria, it's fairly straightforward. There are a lot of myths out there about it's very difficult. What do you do? How do you set up the company? And if people haven't had the experience of owning their own limited company before, it may be might be a bit nervous about it. They're going into might be dipping their toe into the buy-to-let world, and all of a sudden they're owning their own limited company. One thing I'd say is don't worry about it. It's very, very simple. Setting up a limited company is very cheap, as most people know. And with regard to lenders, their criteria with the limited company itself, or it's got a limited company SPV, is that it just needs to be set up. The main criteria, it needs to be set up purely for buying, selling and letting or managing investment property. Okay, it's simple as that. It cannot be used for absolutely anything else. Now, and I can't reiterate that enough.
Yeah,
because
and what I would say on that, Simon, we've talked about that in previous episodes, and some of those I've referred to on the podcast are going to highlight that. So
cool.
We don't need to go into that, but it's definitely worth
excellent. Yeah,
underscoring that.
Definitely. So I make that point because I've had it and lenders have an issue with it. So you then go to look at what sort of criteria looking with things like how long does this, does this SPV or this limited company need to be in situ for? Well, the answer to that is for most lenders is day one. You can have the company set up on, and I have on numerous occasions set the company up in the morning, put the application through in the afternoon. It really is, and I would say the majority of lenders. Now, I'm not going to pick out the lenders at the moment because there are hundreds out there, and I would say I would put my hat in the ring and say probably 70-80% of the lenders would allow day one limited companies. So that's not a concern. So you don't have to worry about having any sort of trading. And then the other question is, do you need things like accounts or bank statements? No, you don't. I mean, you will need a bank account, yes, but that can follow. So don't worry about that. The other question which is raised quite a bit is, well, if I have that limited company, do I need an income from I've left. There's a couple of occasions where they've left companies or left their job and want to be setting up their own investment business, free property, whatever the case may be, and concentrate on that. Again, it's on a case by case basis, and there are lenders out there who will look at what type of income you have. Now, if you don't have any income at all, it's going to be tricky. You are going to be limited to lenders where you can go and what you can do. There are people out there. There are lenders out there who will generally look with no income at all. Or let's put it that the other way. They want to know that you're working. Okay. But then they haven't got a minimum requirement as to whatever income you actually need. So that can sometimes fit. Certainly, you can use if you're a full-time landlord, the rental income you're getting in, you can use that as your income requirement. And it's that when people say, well, why do you need that? It's a buy-to-let. Lenders are looking, or the feedback we're getting, and they're looking at rental voids, issues with the property. You guys know, doesn't always run particularly smoothly. So therefore, they want to know that you have some sort of income in the background that just in case anything happens. It's another layer of security for them.
Well, what sort of evidence do they request and require for proving these other incomes and what have you?
It's very much lender to lender. Some lenders will, if they have an income requirement, it will be the classic case of pay slips or tax calculations for the self-employed. But quite a few don't. Quite a few lenders will not have any requirement whatsoever. So they simply don't. Now, we as brokers, as good practice, we will always take proof of income in because, again, for us, it's just an extra layer of security from our side to say just to know that the client is happy and we're not putting them into a position where they can't afford it. As simple as that. Yeah.
The ones that do look back at income or look at income currently, how far back do they look, or do they not really care about that? Is it just current?
Yeah, pretty much. It's pretty much current. Again, you could look at things like that would then touch slightly on the time of employment. So, do they have a minimum time? And again, it's lender to lender. Most lenders will want a minimum 12 months in a current position. That's a general rule of thumb. So if you go now, that's not to say that if you've been away, if you've been working abroad, or you've been abroad, or you've been out of work for a while, and you want to start investing, that there aren't lenders out there, because there certainly are. Now, That may then go slightly on. You may be going to the more specialist end of the market, and there are a number of them out there, the smaller building societies or the likes of Fleet and Keystone, particularly, who are we'll look at slightly quirkier. Fleet of at the moment, to throw a name out there at the moment, are really, really good in the limited company market. They're really flexible. And although they do tend to ask quite a lot of questions at application stage, they're really flexible and they really are trying to work with you. So someone like that will then lenders out there a help.
I think it's a good place to think about the myths that we're already busting, because one of the things that frustrates me, because when you're new into property investing, one of the things I heard anecdotally was, well, if you're not earning money and you create a company, you might be able to borrow, but probably not. Actually, that's not the case. There are varying circumstances, and as you say, there's different levers. So depending on the situation of your limited company and you as a person, some of those things might change. For example, you might have to pay a higher rate for a mortgage based on the financial circumstance of you and the business. And I think that's probably a good place to move into. The three things I tend to think about for limited companies are what changes, because this is the stuff I hear online. Oh, well, yeah, the limited company rates are so high, it mitigates any savings that you'll get from changing as a person, or the fees are really high, or the loan to values are really low. So why don't we just get into that for the listener, which is, as a limited company, what can we expect changes in terms of rates and loan to value and potentially fees?
Great question. Sure, it's going to be more rate. Loan to value, from what I see, is not really going to make too much of an issue. Generally speaking, limited company buy to lets, the maximum loan to value you're going to get is 75%. Yes, there's always a caveat on this. Yes, there are a few 85% rates out there. Yes, they're much higher. Do they fit on stress testing? Very, very rarely. It just generally doesn't happen. It will sometime happen on an HMO property because the rental's that much higher, and you can stretch if you want to, but you're going to pay a premium. Now, rates, we'll dip our toes into rate, and I don't want to dwell on this too much, but it crosses over here a little bit. For example, lowest limited company buy-to-let rate on the market at the moment, it's 75%. For 2 years, it's 3.99%. 3.99. I hear the cheers in the background there somewhere.
But we don't trust you, Simon. We know that you've got something in your back pocket that you're going to bring out.
Always trust a broker, Stuart. Always trust a broker. That comes with a whopping great big 7% fee.
Oh.
So 7% fee on a 2-year fixed rate. Wowzer.
I'm just going to pause there for a second, because we talk about average property prices, right? And based on basically the latest average UK house price, it's around 260,000. So I just want to call that out, because 75% loan to value on that is £195,000. If we say it's £260,000 average price times 7%, because I just want to bring this to life.
Yeah,
£13,650 just for a fee.
Yep.
So on top of your stamp duty, on top of your fees, on top of your mortgage, nearly £14,000 on an average UK property to get the 3.99. I just wanted to also have a moment of silence and somberness to fully appreciate what that actually means.
Yes. Should we bow our heads and sort of? Yeah.
Well, if I could put the pressure on Simon, we could play some. We could play the funereal march, just as we go through this
as it goes in. Absolutely, we need to do that.
An edit request too far, I think. There.
Yeah. Sorry,
It's just crazy, because if you just think about in the current market, which is drifting downwards or holding steady, if you're feeling more confident, I mean, how long is it going to take you to recoup that £13,000 in the property value? Never mind the fact that it's 13,000 plus 25%, because it's only on the mortgage part. So yeah, I mean,
in theory, this is the only way some properties will get to 75%. That's it's as simple as that. If you want to buy a particular property and you only have 25% deposit, the only way the stress testing is going to work is if you choose a very low rate. The very low rates then come with a 7% fee.
And I would just say on that, sorry, Simon, to interject you there, but I would just say that even if that was on a 2-year, the interest on that fee alone, in my simple maths, was about £560 a year. So you're paying almost £14,000 for the fee. Simon P's laughing because I'm getting up on my little soapbox now. You're paying £14,000 for the fee, and then you're paying in over £1,100 for the interest on that fee, because no doubt you're going to add that to the loan, because most of us don't have an extra 40k. Now, and if you extrapolated that out for 20 years, of course, it's an interest only, so I'm not suggesting you'd keep that for 20 years, and none of this constitutes any advice to anyone. And of course, the advice is here, don't trust banks. But you would pay over £11,000 on that 20-year term. So actually, if you extrapolated it out, there's £25,000 just to your friendly bank person.
Yeah, but the capital growth in this property, you're going to make an absolute fortune, Stuart, aren't you? That's the thing. It's a win-win. What can you do? You get the mortgage, and the capital growth is going to be huge, and the rental is going to be spiraling out of control. I joke, but you're absolutely right. It would be interesting. Going back slightly to stats I heard at a seminar a week or so ago, lenders they're about applications are down to about half they were last year, month on month. So they're looking. You can clearly see, and that is going to a huge amount of that is going to be buy to let. Huge proportion of that, because the buy to let market is clearly very, very quiet. We know the residential market is certainly damping down. We're getting quieter over Christmas, because it does. Although, funnily enough, Rightmove always say the busiest time of the year on searching properties is Boxing Day.
Boxing Day, yeah.
Yeah, which I'm not. I think that might be a bit of a marketing ploy there. I've got better things to do on Boxing Day than that. But I think they have to do something. Lenders have to do. They're trying something. We've been joking around it for a few months now, haven't we? But circling back to where we were, right? What is the difference? What if you have something a little bit quirky? What if you've only been in a job for a while, or you turned self-employed 3 months ago? It's very unlikely that I don't come across it very often where someone actually comes in and said, I don't work, full stop, but I want to invest in a property. It's unlikely, because you're just putting yourself into a difficult position now, because you don't know what's around the corner. But then, if something like contracting or in between contracts, that's definitely something to work for. What are you going to then be looking at? I would say, I'm just looking at rates at the moment. I would say you're probably going to look at a rates of around about 5.75 on a 5-year fixed rate with fees. Now, fees then are about 2.5%. Lenders, limited company buy-to-let lenders are pretty much across the board going for higher percentage rates. We're noticing that.
And is that on a 75% loan to
That'd
value?
be set. Yeah, I'm just looking at 75% LTV. So that would give you a bit of an idea as to no, you're not going to get the 3.99 with the lovely 7% fee. You are going to pay slightly over and above. But then that sort of goes back again, saying, and we were talking a few days ago, weren't we, off camera, about the differential between residential rates and buy-to-let rates. There isn't a huge amount of difference, certainly at the moment. And limited company buy-to-lets and personal buy-to-lets, that's something else. Sorry, touch slightly on that with on the personal side. another myth is, oh, well, I go to a limited company and I'm going to pay a lot more money. No, that's not the case. Quite often, and the large, it's just say larger lenders, the rates are the same, and the fees are the same. So they have they are genuinely looking to try and get business in. Whether it's working or not is a different matter. But the rates are generally the same. So another myth quashed there by your friendly mortgage broker, to say that they're pretty much they're the same. And I would query your broker if they're not. But that might be a criteria issue.
Yeah, and I think that's really good in terms of just summarising that, because obviously we've talked about quite a bit there, and I dragged us off on a tangent. But essentially, what we're saying: rates similar, loan to value similar, fees similar, with an asterisk saying highly dependent on your criteria, the limit, the criteria of the company, and you as the individual or the director of that company.
Yeah, absolutely. And I'd say that don't worry too much about where your income is coming from. If it's investment income, I'm talking about background income here. To when you're looking to apply, don't worry about too much about it. Don't let it be too daunting. Setting up a limited company, that's a very straightforward process. Income in the background, you can have it from pretty much any source: commercial properties, mortgage-free properties, investment income, pension income. There's also it's on a case-by-case basis. You can also have benefit income, or benefit-only income. A few lenders will look at that. Again, I would then question, on a broker point of view, well, how are you looking to, are you going to be okay financially? But if they're using the property then as an additional source of income, it can make sense. If they've got a lump sum, they're looking to invest, don't know anything about the stocks and shares market per se, or investments. They want to invest in a property so they can get an income. All that makes sense. I can see. So there are different ways you can certainly look at it. There, that's good. Other thing I'd certainly say, going on about the property, something which has come across recently, which has always been a big no-no in the buy-to-let market, is property above commercial. That's another myth. People are saying, often come because I can't be above a takeaway, can't be above a restaurant, can't be above a laundrette. Ask your broker is number one, but there are now lenders, and more of them, who will consider that. And that's a fairly recent change, and they quite like looking at those. Again, I would imagine it's not as much of as a health risk anymore. They don't have the fires in the laundrette, which they were always worried about. So actually, it's quite a good security from the lender's point of view. So again, something else, just a general buy-to-let overview, and it sort of helps when people are looking at property, not to discard anything, because you can get some really, really good, nice, sizable properties over commercial. Generally, you look at high street, and any property over a high street retail unit is always really big. So that goes both into personal and limited company. But again, I would expect most people then to seriously consider buying in a limited company name.
We actually looked at buying a property over a laundrette, and I've talked about it on this podcast actually. And that was okay. I think the loan to value was lower, and there was obviously a number of factors, really, just to kind of exemplify the point that we've been talking around today. I think there were too many factors, but the other one I really liked, turns out it was over a vape shop and a barber's, because it was quite a property that expanded over, on a high street that went over quite things. Went over a vape shop, a barber's, and a fish and chip shop. So it was like really it wasn't going to happen.
No,
it wasn't going to happen.
You've hit the jackpot there in every sense. Yeah.
Oh, the key one was the vape shop. just to make it really interesting, also sold fireworks. So you can imagine the local bank surveyor going out to that. So do we really trust this security is going to stay up for a period of time for the 20
Yeah.
years that we're going to provide this mortgage? Yeah,
Yeah,
didn't
I
work
would.
out.
No, strange that, isn't it? Yeah, absolutely. Apart from like someone at the front lighting matches all day long, I mean, I'm not really sure what else. I would, yes, refer to your again, refer back to the broker on that one. And what we can do, and quite often, is the lenders are offering a really good. Some of the lenders are offering really good service, so you can call up the lender on behalf of the client and say, "Oh, they're looking at this. They're looking at this fireworks shop next to a bomb disposal unit, and seeing if it's okay." But something like that, I would have probably said straight away, "Oh, you're going to struggle on that one." But as an individual unit, there are a lot of retail units out there which are, because they also know these things. Retail units chop and change, don't they? 1 minute they're a charity shop, next week they're a vape shop, next week there's something else. Takeaways and restaurants open and close all the time, so they know these things can change anyway. So definitely worth thinking about, and they generally are. They can be very, very good rentals. The only thing you've obviously on the back end of that is, well, what's resale like? What's that going to be like in 5-10 years time? Because although buy-to-let lenders like it, not all of the high street lenders like it. So if you're then looking to sell on to a first-time buyer or someone who's moving, just wants to be in a high street, is it going to be saleable later on? That's something you've got to sort of look at the bigger picture for. But
So, putting fireworks shops aside, how does sort of the paperwork side of things compare between personal names and limited companies? Is there any difference really in what people would expect there?
not really, no. There's some additional work we do on our side, but minimal. It really is minimal. We have to take details about the company, the directors, the shareholders. Generally, you only need to know about the shareholders if they've got more than a 25% holding. But no, not a huge amount more. That some of the lenders, I say some, I can't think of any who don't, will want a personal guarantee because it's a brand new limited company, which is fairly standard. It's pretty much what you would be signing for if you're buying it in your own name.
Yeah, my experience was that a few years ago, I would say that when I transitioned from personal to limited, it felt like there was a lot more paperwork from our side. So for personal mortgage, because we had to do like 3 years, we had to, at that time, we were providing accounts, we were doing portfolio schedules and so on. My experience is that personal, and because of all the changes that the government have done, I think it's caught up. So the level of administration is not as huge a jump, because for a limited company, and we've talked about this in the past, the reason the government I hope one of the reasons they did it was because they wanted better accounts, so they could shore up the people that were running buy to lets, that maybe, let's just say, off book is the simplest way to say it. But it feels to me like, and I suppose I haven't done a personal for a bit, but I'm guessing now that the expectation from the banks has been raised. So where more people are buying in limited companies, their expectation is, well, we'd want that same information whether you are buying as Mr. Smith or buying as Smith Limited. Oh, actually, we want the same level of information because it gives us a better understanding of the security of the entity that we're loaning to. So it feels to me like it's grown.
Yes, it has. I mean, there are. I think originally, if you remember when we were looking at it, I can't think how many years ago it was, Stuart, but 5 years ago, maybe something like that. When people were looking or going into limited company name, lenders were looking for a business plan, quite a detailed assets and liabilities schedule. The portfolio, so those sort of things have gone because it was all new to them. They didn't really know what to do. The business plan was if they're honest, was completely worthless. because I never had one come back saying, well, we don't actually like that. You're then because what you're doing is sending it over to an underwriter to then start understanding what a business plan was looking like. That's not their field. So that was very difficult, but it was, I think, from a lender's point of view, it's a tick box exercise. Right? Okay, this is an extra layer of security we've gone through. The additional work for us poor old brokers are portfolio landlords. That's where the administration and time comes from, inputting all the properties over and over again, and probably for someone like yourself, Stuart, is then if you've got once you've got that information, where you don't have to go over it again. With a portfolio landlord, I don't have to then go back and say, oh, can I have all of your mortgage account numbers, all of your balances, all of your rental? It's just a quick, right, okay, is this up to date? And however many, yeah, fine. Most clients really like it as well. You've got a spreadsheet, although I find most clients will then have their own spreadsheet. That's a sensible move straight away because it gives you all the information. But if they don't, we've got one. And then that all gets passed over to the lender. So that is something. Now that's something I'll going back. Good criteria points. Glad you brought it up. It's with portfolio landlords. Again, it's something. If they haven't done anything recently, or they're looking to do something in the future. Now, some lenders will stress test the whole portfolio. Okay, at certain rates. We did talk about stress testing. I won't go on to about stress testing and ICRs today because it's a minefield, but certainly talk to your broker. And what I would say is if you want something very generic, you can get it online. You can work out what the stress testing being, that how much rental you need for a particular property and how much you can borrow.
I'm just going to mention, because I'm one of these people, when someone mentions an acronym, I like just to break it down, because in corporate land, I used to hate hearing acronyms because everyone assuming that we're... So ICR, interest coverage ratio, and that is where earnings, so we divide earnings before interest and taxes by the total amount of interest expense on all companies' outstanding debts. So that is as much as we're going to say, but we see it as a bit of a rental cover calculation. But essentially, it's the bank trying to understand what the exposure of the limited company is to existing borrowing and whether or not the additional borrowing is going to stretch that too far, and then their security or the money that they're going to lend you to buy is at risk or not. And that is my very simple, I hope, explanation of that.
Perfect. Loved it. Love that. That sort of is. That was as if you read it off the off the internet. But I
did not Google. I did not Google ICR. No.
Absolutely. But that's perfect. Exactly. We can and again we can go in more detail at another time because it can go. But generally speaking, that's what you're looking for. You need to know when you're looking at a buy-to-let, you need to know what the potential rental of the property is and the value, and then your broker can then look at the appropriate lenders and who fits, because different lenders have different criteria. And that then goes on, very important then for the broker then to know exactly what your portfolio looks like, because some of those lenders will then stress test your whole portfolio. So in their eyes, to ensure you're not again running at some sort of loss or you're geared up too much. But then there are other lenders, larger lenders out there who will not look at your portfolio at all, as long as it's basically washing its own face, and they don't see anything. A lot of people will then just generally look over the portfolio. Some won't look over it at all. As long as it's on file, they're happy. Again, that's where we come in.
Thinking about people with portfolios, or perhaps thinking of building their portfolios, something I see online from time to time is a suggestion that you should set up a separate SPV, a separate limited company for every property you buy. Do you think that's a requirement or a sensible way forward?
I'd love to know that. The simple answer is no. That just sounds like
I could tell that just by your face.
I was like, my head was just about to explode then. All I'm thinking about is the admin to that is going to look at, right, can we have the last 3 months bank statements on each of your properties and each of your SPVs? I mean, your accountant will have it will explode. Your mortgage broker's head will explode. Your head will probably explode. so your bank. I'd love to know the rationale behind it. There's obviously someone has thought of something and think, right, okay, this is what we need to do. I've seen it before where people put properties and they've either developed or they are going to develop into a separate SPV. That's fine. You can see the reasoning behind that, costs and whatever. If it's a big development, I can see that. Each one, why would be the question now. I don't think it would particularly help. My head would explode thinking of how I would input that with each lender, with each limited company. I hope that doesn't happen, Simon, to be honest. That would not be good for me.
No. I think that was another good myth to bust.
I think
Yeah,
so.
absolutely. And I think, there's a big point around there around size, because if you're talking about properties that are multi-million pound properties or developments, then of course that makes sense. And in your accountancy fee becomes just a minuscule percentage of that, versus if you're buying properties for 30, 40, 50,000 pounds plus creating 10 different SPVs for that. Again, there has to be a very good reason. So I think you've covered that off very well, Simon. So as we wrap up, the one thing I just want to say to people is we are talking about this from a perspective of just trying to help everyone understand a little bit more about the positioning of mortgages in limited companies. This is, of course, for everyone to really look into for themselves. We are not necessarily advocating it, although clearly we do it. We buy limited companies for our reasons. Of course, it's up to you and your own situation to work out if that's right for you. And again, we've talked about that on previous episodes. So please do look those up. If you've listened this far, we're assuming that you are enjoying the show and you've got some value. So if so, please do leave at least a rating on your podcast player of choice. And if you feel that way inclined and want to shout out, please do also leave a review. Other than that, it just leaves me to say thank you once again to Mr. Simon Glastonbury for sharing his experience with Simon and myself today. And other than that, we'll see you on the next episode.